Goldman dropped a note after the close today that should grab anyone trading equities tomorrow. The S&P is 1.01% above a price line. Below that line, computer-driven funds are forced to mechanically sell $46 billion of U.S. stocks, and the order book is the thinnest it has been in over a year. This morning, Barclays said the forced selling was already done. Vol control cut 25 to 30 billion. CTA Nasdaq positioning was back at the 27th percentile. Buy the dip. 8 hours later, after the close, Goldman's flow desk published numbers that say the unwind has barely started. Here is the math. The S&P closed today at 72.67. Goldman's trigger line is at 71.94. That is 1% away. Less than a single bad day. Below that line, the computer-driven funds have to mechanically sell $46 billion of U.S. equities. And the positioning is loaded. Computer-driven funds are currently long $46 billion of U.S. equities. That is the 65th percentile of length over the last 5 years. They are still heavy. Barclays measured one slice of the book. Goldman is measuring the full book. And the asymmetry is brutal. If the tape goes up, these funds buy 2.3 billion more. If it goes down, they sell 46 billion. That is 20 to 1 against the market. They have an enormous amount to dump and almost nothing to add. The market just has to flinch. And the amplifier is liquidity. The S&P's top of book depth is sitting at $4.15 million. First percentile over a year. The book is empty. So 46 billion of supply hitting a market this thin does not get absorbed. It gets dragged. So what to watch? Tomorrow morning at 8:30 Eastern, the PPI print. Cool, and the trigger holds, and Barclays' call ages well. Hot, and the S&P drops 1%. The trigger breaks. The 46 billion starts moving into a 1 percentile order book. That is not a normal sell-off. That is an amplified one. Daily synthesis of what the big banks and Wall Street quants are seeing. Follow.